All right, investors, I'm here once again with Karl Cheong, Executive Vice President and Head of ETFs over at Ninepoint Partners. So, Karl, welcome back.
So good to see you again, Jordan. Look forward to the discussion today.
Yes, and today it's a big one because we don't typically, even for me personally, typically make content as more reaction videos or response videos to people in the finance space. But I think this one is an important one, and we're talking about Ben Felix's couple of videos on why cover call ETFs are BS for long-term investors. And so as a FinFluencer and talking to a fund manager, I thought it would be a good idea to bring Karl on, as we have a good relationship, to just chat about some of the points that Ben had brought up. So basically, all the questions I have for Karl are directly derived from Ben's latest video on why cover call ETFs are BS. But Karl, maybe let's just start there. It's very simply put, are cover call ETFs BS? What's your response?
It's a fair question. And I actually think it's good that investors and commentators like Ben ask that question. Covered call ETFs aren't designed to beat the market. Point one, they're income tools that take volatility and turn part of it into cash flow. They do that by selling call options on stocks the ETF already owns. Think of RBC or TD and writing options on those. Here's the trade off in real plain language, however. You get smoother income, but you do give up some upside if markets really take off. These strategies tend to work best in sideways or choppier markets where income matters more than just maximum capital gains. So, no, they're not BS. As long as you understand their income for partial upside trade off products, not market beaters. Does that make sense?
Yes, I think it does. I think one of Ben's biggest contentions is people using it for long-term wealth, for building wealth long-term, and that's something that he touches on in his videos. Is that I think there's misalignment there between, I guess, what he figured is investors' long-term expectations in products that are generally not meant for that.
Mm-hmm.
But as I have experience, and I've been investing in these things now for about 3.5 years, and the ironic part is I am using it for wealth creation,
Yes.
but part of it too is it's just also a very interesting product, and there's such a community following, which wasn't necessarily there 3.5 years ago when I first started, but there is now, and people are really intrigued by seeing like what people like me and others out there can do with these products, whether it's for wealth building or if it's for retirement or if it's for living abroad. I just think they just want to see what people can actually do who are bought 100% into these products.
And they're really for someone who wants, you mentioned wealth creation goals, but even predictable monthly cash flow and a calmer experience. Yesterday was quite volatile, but you mentioned before you were getting distributions on the day of the sell off. So it can be a trade off that I think makes lots of sense in different ways. And for someone chasing just real hyper pure growth, it might not also be the right fit. So let's put that on the table as well.
That's right. I mean, the cover call industry is let's face it, we're in this modernization era of income investing. In my 5 years investing, which it's not the longest time in the world, but in my experience so far, I haven't really seen anything quite like it, where you take something like growth investing, dividend investing, income investing, other types of investing. It seems like this one seems to be going through the most evolution, and there's a lot of attraction to it. I think it's opening up a lot of minds to what's possible. But anyways, I got another question for you here, Karl. And this is a big one that again Ben touched on, and we got to address it, which is, are ETF issuers the only ones to benefit by selling cover call products to investors? Are there other incentives? So Ben's basically, I wouldn't say he wants investors to be aware of the fact that that the ETF manufacturers are typically the ones to only benefit. So, like, is that true or false? Can you maybe elaborate on that?
But you certainly can weigh in, given you've been investing in these products for a while. But it's a good question. I think transparency matters here from the manager's perspective. The manager, not the ETF itself, earns a disclosed management fee. I'll talk about our own product, which is really stated clearly in the ETF facts, the prospectus, whatever information you glean from our websites. But for example, the Ninepoint high shares funds are going to charge 0.29% after the fee waiver, which ends in next year, which works out to be $29 per year for every $1,000 invested. And to put that into money terms, in exchange for that, investors get professional management, institutional trading access, and daily liquidity. At the ETF level, arguably, the ETF manager can execute option trades at institutional spreads, better than retail spreads, and finance position. That's the leverage, the modest leverage we'll talk about in upcoming questions, at institutional rates, which might be a little bit improved relative to the retail offerings, which I feel individual investors typically don't have access to themselves. Long term, a manager only grows, this is really important, if investors stay satisfied. If you're happy with our products, Jordan, great. Because in ETFs and ETF investors can redeem at any point in time and pick from the 1,500 other products that are available. So alignment with the manager and the investor is very clear. I feel the structure is clear, it's transparent. And the only way an ETF manager can grow is really via sustainable outcomes and what we promised our investors.
Why might someone choose covered call ETFs to receive income versus holding stocks or ETFs to get dividends and sell shares to generate income? What are the negatives of trying to create your own income in this manner? So this is a big one that Ben touched on. This is like for his last video, this was like right front and center was the idea of like why bother paying a higher management fee? Why bother the active management, the potential high risk, capping upside when you could just hold the underlying and then just sell? So this is a common argument. So
Mm-hmm.
sell shares off as you go. You get a higher return. It's cheaper on you. Why would somebody like what are maybe the negatives
Yeah.
of doing that?
Yesterday was a good example of what happened in the marketplace. So you can sell shares, as Ben mentioned, to create income, but it does require some timing and discipline. And if markets fall early, as I mentioned yesterday, or take a look at Liberation Day, you risk locking in the losses just to meet cash flow needs, which is detrimental to long-term wealth. A covered call ETF systemizes that income generation. Instead of selling units, it sells option premium, it sells the volatility, generates income, keeping the core exposure invested while generating cash flow to fund lifestyle needs. It removes the need to manually really deciding when to withdraw. So ultimately, it comes down to fit. It's your goals, risk tolerance, and time horizon really should drive whether you do it yourself withdrawals, as Ben was talking about, or delegate the structure to a covered call ETF, which you have done as well, Jordan.
Yeah. You know what? He had some great data over the long term, like what the like if you were to sell right like over time and basically I'm sorry everybody we don't have the graphs or anything here
Mm.
for that but it was basically just to show that yeah so over a long period of time if you were to do that and sell
Mm-hmm.
shares in the future which is what most like for all of investment history that's what people have done they've just sold off chunks of their portfolio they've decumulated over time the 4% rule so this idea is not new. I mean, when you phrase it maybe in a different, slightly different way, right? It kind of maybe wakes people up a little bit. But I'll give the audience a bit of a scenario where this doesn't really work and why an income strategy does actually potentially make more sense. I'll give you two examples. My wife's parents just started investing in their 60s. My mom just started investing for the first time in her 60s. So this idea of I'm just going to go after total return for the long haul doesn't really work. Like my both sets of parents need income now. They need to generate that for their lifestyles now. Cover calls offer that. And structured properly, of course, that's a big one. That comes with just kind of more time and just learning about the systems of investing where say for both my parent or both sets of parents, their portfolios are doing just fine. They're not in anything crazy, but and they're getting that monthly income where they otherwise would not have been. They would have been whittling down, the sale of a home, or well, both sets of parents had sold their homes. They would be just whittling down cash. But it was important to me to express to them that that this will be preserved a little bit better if you put it into the markets, but done in a sustainable way. Okay, so Karl, for our next question, how does leverage help out cover call ETF investors, and what kind of strategies can ETF issuers do with leverage? Ben alluded to leverage in these products as fascinating pieces of financial technology. Probably the only positive thing, slightly positive thing that he said about cover call ETFs
Yeah.
in the right his latest cover call ETF video. But what would be your take on leverage?
Leverage is really one of those terms that gets lots of attention. That's stated. It's worth explaining clearly that in the covered call space, some managers, Ninepoint included, choose to use modest leverage, often around 25% additional exposure. So part of the design of that is to support income potential. In simple terms, that extra exposure may help the ETF really track the underlying stock more closely in steadily rising markets. And we've seen that these products have been available since 2022, where they're using leverage and covered calls, and they've tracked the underlying very closely. But it's also important, and just be clear on the other side, leverage also easily increases the volatility and can magnify losses if markets move sharply against you there. So leverage isn't good or bad on its own. It's really just a tool. It's key to understanding how much is used, how it affects volatility, and really if it matches the risk comfort and your income objectives on that front.
I think at this point, the ecosystem, at least up here in Canada, I think everybody is so used to having that leverage component with their cover call ETFs. And even in my own experience, they've seemed to have helped offset that drag of capping the upside that I mean we're so used to hearing, which once again is a big proponent of Ben's video is why get into something long term when it caps upside, and leverage seems to help that out or at least mitigate some of that capped upside. For the next one, how serious do cover call ETFs cap upside? Don't managers just buy back the shares anyways, albeit at a higher price, thus still allowing for upside growth?
It's really important. Yes, it's important to acknowledge that up front. When you sell covered call, you're agreeing to give up some of the upside past the strike price. We can agree to that in exchange for immediate income via the option premium. So how much upside you give depends on the overwrite level, meaning how much of the portfolio is covered by the options. For example, Ninepoint high shares typically overwrites up to 50%, preserving 50% plus of the growth potential of the underlying stock. We're also laddering strikes of our options to give upside there and actively managing that as well. Other ETFs in the marketplace overwrite up to 100%. That's maximizing all the income you can at this point more aggressively. Really, you have a choice. You're choosing a place on the spectrum: more income, less upside; less income, more upside. Neither is good or bad. It's more about fit and intention of the end investor.
I see. And just in case investors have further questions about that, I mean, when you guys do, when if those shares get called away that you guys managed, but do you buy them back right away? Is that how typically that works in the industry?
It's two ways.
Hmm.
Historically, you do have the option where a lot of the industry participants know the stock will be called and roll to the next week or next month, depending on the ETF asset managers practice. Or if you take delivery and you accept that the stock is going to be called away, you can accept the capital gain and then reinvest in the stock to make sure you get exposure to the underlying.
I see. So then basically the strategy just kind of resets at that point, I guess, for investors. So anyway, that was sort of, I think for investors, they would be curious to know is that once it resets, you're setting a new strike price, which is obviously higher than what was there before. And again, you're buying at a bit at a higher price, but now there's this new cap essentially at that point. Is that like basically how investors can maybe try to understand that?
100%.
Okay.
You have a new maturity,
Yeah.
a new strike price, and potentially further out of the money. And that's the other consideration you'd have to say: is it closer to the money or is it out of money? If, for example, if it's 7% on the money, you do have upside potential up until that point.
Mhm.
And then the ETF manager will have discretion as well to roll it to the next week or month and maintain that process throughout the year.
No, you know what, Carl, that's good info there. I really do like that one. Many fund managers in Canada do not write call options on 100% of the portfolio that I know of. Usually in the 30 to 50% range, allowing for the other half to grow. How vital is this call writing strategy to fund managers? Do you guys care about natural growth?
Absolutely. It really depends on the mandate, the investment objective of the underlying security. In our case, I'll speak about Ninepoint's view. We want the investor to get exposure to the underlying growth story of the stock. For example, if you have a Shopify, Shopify has tremendous fundamentals, long-term economic prospects. You want to be able to benefit that. Shopify also does not pay a dividend.
Mhm.
So potentially you've never invested in Shopify, but you actually want some income potential. In this case, you're getting one to one, almost one to one exposure to Shopify by using modest leverage and a covered call strategy to generate the income in that space. So what we've noticed with terms of the returns, and I've spoken about this a few times, is that the leverage adds a boost in upward markets as well as in downward markets. It's a dual-edged sword that way. So you're getting more return in more modest rising markets. Plus, the covered call option actually dampens returns. So what you end up getting is more of a beta of one to the stock, which means you're getting the growth of the stock, but at the same time, you're clipping a very healthy coupon throughout the way. And I think that's made it more attractive and very interesting to lots of investors.
And you know what? To that point, Carl, and I think that this is sort of um, I see it on both ends of the spectrum, whether it's growth or income. Both sides have this bias towards getting all of their return in one format, whether
Mm.
it's all in growth, which historically obviously has worked. It just depends on what you're going for, or it's all in the income, which again, if you're writing on 100% of the portfolio, your total return is naturally gonna suffer somewhere, and that's typically shows up in the price. Now, I don't know about you all on the other side of the camera, but I would be if I was the average investor. I get pretty antsy when my share price is declining, despite obviously the total return. Now, for an income investor, most of your total return is going to end up over in the income bucket versus over here. But I like to at least bring up the conversation of for investors of just try to understand where your total return is coming from. I think that's so crucial. I mean, how much of it are you aware of is coming over from the capital appreciation bucket versus the income bucket? And I just don't see that necessarily talked about a lot. It's sort of total return be all end all. And I get it. It in a large aspect, yes, of course. But knowing understanding where your total return is coming from, I think can really help you maximize the efficiencies of your portfolio, whether it's for the long term, short term. I'm 35. I got decades still ahead of me to go. So having uh, these funds to still be able to naturally grow, I find for myself personally is actually a really huge benefit, and I really appreciate the various fund managers that opt for these sort of hybrid approaches. So, I mean, most of the products, including the high shares products themselves, are really hybrid products.
Mhm.
Like they are not like pure income strategies where it's like on 100%. So if you're getting into something like high shares, you are effectively taking a half and half approach where you're getting half the income and that participation on the capital end as well.
And there's a like it's a really good point, Jordan. I think there's a trade-off. Even taking off the leverage,
Yeah.
one is you have a lower option premium equals potentially slightly lower distribution potential when you're saying total returns, but better long-term compounding potential in that instance. And then the other side, the other trade-off, like if you were to overwrite 75 to 100%, the upside is capped more aggressively. If the stock or sector makes a strong upward move, the ETF might lag significantly, which affects the total return and compounding over time. So, barring the leverage, that's really the trade-off that investors need to think through.
Of course, and just for the topic of leverage, it's your friend in the long term. I think that's the an important point as well. All right, Karl, we have one question left here, and I think you'll like this question because it has to do with the Blossom event. But here we go. Karl, you were surprised by how much investors knew about cover call ETFs at the Blossom event and their questions, where Ben's take is one of struck by how widespread this financial BS has become at
Yeah.
this event. Two vastly different takeaways. What does this interest mean for the financial literacy of the community? Do you feel more people are engaging more in finance because of cover call ETFs? What do you think?
Events like that Blossom Investor Conference, for example, wonderful to see. It suggests there's a genuine curiosity about how these ETF structures actually work under a hood. There could only be benefits. From what I've seen in the past year alone, more investors appear to be asking very deep questions. Think about our conversations. It's really wonderful you're educating your audience. It's not just about yield, but also about the option overlays, the overwrite ratios, and even the leverage exposure that we just dived into. I wouldn't call it universal yet, but there's definitely a shift in conversations happening online and at these events at Blossom. If this trend continues, greater awareness may lead to arguably better decision making because investors will choose these products based on intention rather than just the headline yield alone or the ticker, which is historically how some investors have made some decisions. So I think some of the critiques we're getting in this industry, including voices like Ben, have played a role really in pushing the managers like myself, the ETF managers and representatives to communicate more clearly about the trade-offs in a structures. That can only be a positive.
Yeah, you know what? I will say to Ben's credit, I will say that I'm surprised it's taken this long for someone as big as Ben to come out with say a video that makes people think and not just sort of blindly follow. And maybe there's some rhetoric in there that people didn't appreciate. And I'll even say that for myself personally. There was some stuff said in there that I was like, that video could have maybe done without. But nonetheless, here we are, we're talking about it. And at the end of the day, what it's going to bring to is an awareness and an education whether people should seriously consider an income strategy for, say, maybe the long term or short term, whatever their preference is, versus just getting into regular equities and riding things out for the long haul, like they have been for the past couple of centuries. And so anyway, it's I gotta say, from the event which I was at, and I got to meet Ben there actually as well. Um, how many people came up to me, and I know yourself, and were just telling me their strategies, telling me about their lives. I did a breakfast with a bunch of investors that before the event even started. I've done a couple of these events now in a small group setting, talking with income investors, and I gotta say, the wherewithal and just the financial literacy, the education, the experience, and I was really impressed. I gotta say that people are, despite if you could just look at someone's portfolio and just look at the tickers and not know anything about them and just assume that they're out to lunch just because they're into cover call ETFs. But you actually meet these people and get to talk to them, and you quickly realize, like, hey, you got a plan and you got conviction, and it sounds like you got your, you seem to have a lot of this under control. That was my takeaway. I was just pleasantly surprised, and honestly, like, Canada needs some sort of financial, entrepreneurial renaissance. We need it so badly. And honestly, whatever the means that it comes through, if it comes through interest in finance because of cover call ETFs, great. And maybe later on they decide it's not maybe for them. That's also okay. That's the great thing about being a retail investor, is that you're going to learn, you'll take things in, and you'll kind of just go from there, and you'll tweak your strategies. And it's also nice to have opportunities like what we're doing here to speak to or hear from finfluencers and creators, both sides of the same coin. They need to exist in unison to get the right information out and give a more contextualized, I guess, reality of what it's like to invest in these things. So my my only, I guess, I kind of wish Ben would have maybe. His content is more data driven, so I understand why he might not talk about that kind of stuff. But just, having talked with so many investors, I'm kind of, I would say, maybe just surprised that wasn't sort of part of the conversation, or at least his videos. That these people are true. They, at least the people I've talked to, are really deeply involved in this, and it means a great deal to them. And investing is truly a personal journey. And but on a different note, I am so excited from an event like that to see where where their growth is, and of course, getting into finance, that's going to open up another wave of ideas and ways in which that individual investors can make money, not just in the stock market, but you're going to see trends that you didn't see before. And that's the exciting part, is that it just opens up pathways in your head to find money making opportunities, whether it's in the stock market or somewhere else. I'm in an income strategy, but my growth strategy is, it sounds cheesy, but it's like, it's myself, right? The more I educate, I talk about this, education equals amplification. And actually, at the event, people might want to know this, but I've been following Ben's stuff for a long time, the Rational Reminder podcast. And a lot of the time, I don't know what the heck he's talking about, but I just want to get in tune with the language. That's a big one. And I told Ben, I didn't get to explain it all. I know he was in a hurry, but I told Ben, one of the biggest eureka moments in my investing journey actually came from one of his podcasts. And he had somebody on his podcast that was an economist. And whether I got this wrong or right, I believe it to be true. But anyway, this person basically said that this long form study, if you understand how a credit score works, how an interest rate works, there was one other component. You are 33% better off in retirement if you know those three things, because you'll maybe adjust strategies around these. Well, 33% over a lifetime. Imagine what you'll do and what that education compound effect is like when you start understanding taxes and how accounts work and ETF structures and just the ebbs and flows of macroeconomics and qualitative versus quantitative analytics, all of a sudden that compounding effect is like shoots through the roof and it starts condensing in a short period of time. And from my own personal experience from educating myself on this, as I didn't go to university or college for anything finance related, like I can see that in my own journey where the more education has come in, again, it's never a guarantee. We've also had some decent markets, but the more education, the portfolio is kind of tracked along with it. And that might not be everybody, so no promises there, no guarantees. But it certainly, I think, levels up your confidence and you'll see what's possible.
Honestly, I really love conversations like this because they move the space forward.
Yeah.
Clarity, the transparency, and the suitability. That's what matters most from our perspective on the ETF design. And I think we're finally seeing investors demand it. And I love seeing this.
Yeah, that's great stuff. Well, Karl, unless you have any other points that you would like to bring up, I really appreciate you coming on the channel once again to just do this video to help investors also maybe rationalize the other side of things, which is well, we're taking obviously the cover calls are not BS side of things, so. For those interested in seeing Ben's video, I'll link it down in the description below and check it out for yourself. It is what it is, and yeah, for better or for worse, you know what? It gives everybody a better education on how they can think about their investments.
Jordan couldn't have said it better. Covered call ETFs are tools. And like any tool, they work best when you know exactly what job you're using them for. I'm happy to come back anytime for a deeper dive and appreciate you having me on the channel again.
Sounds good, Karl. Thanks so much.
Thanks, Jordan.